Hi, it's Kris Benson. I'm the Chief Investment Officer for Reliant Real Estate Management. Today I'm going to talk to you about the 4 things your financial advisor is not sharing with you about investing in real estate. Who knows if that's actually true? I have no idea what your financial advisor is telling you, but I'm going to tell you 4 good reasons we think investing in real estate is a good idea for your portfolio. Let me tell you what those are up front. So we're going to talk about the returns of real estate historically versus some other asset classes, the opportunity to use leverage on your real estate asset investments, the tax preferences that exist in real estate versus other asset classes, and the opportunity to invest in something that's non-correlated to the typical equities market. So those are our 4 things. Let's dive into each one individually. First one is returns, and I'm going to reference something. We'll put a link to a study that I really like. It's a group of Fed Reserve employees who did a study. It's called the rate of return of everything. And they looked at over 140 years of data comparing real estate, equities, bonds, T-bills, and essentially they were trying to find out which asset class provided the best return. And they looked at something called real return, which essentially takes into account the value of inflation over the years to give you a real return over what was happening on the inflation of the dollar. So not surprisingly, I probably wouldn't reference it otherwise. The study showed that real estate outperformed all other asset classes, including the stock market, the bonds, T-bills. And to give you some perspective, they provided an 8% real return versus the equities market, or the stock market, which is 7%. Bonds were in the 4% range and T-bills were in the 2% range. So real estate really performed well. And again, over 140 years, it's a pretty long-standing data set. And then they also looked at what the risk-adjusted returns were at. So they factored in what type of risk and volatility you were taking into account by investing in real estate and other asset classes. And again, real estate came out on top. The best risk-adjusted returns were attached to real estate. And I think that's a function of real estate being a hard asset. There's always an intrinsic value to what you're buying in real estate. It may go up and down, and it certainly does as markets fluctuate, but in the long term, there's always a value to the dirt and the building that's inherent upon it, where in the equities market, as you know, historically it's done very well, but you can literally go to zero and your investment can be worth nothing. So it's one of the reasons we really like real estate. The second thing we talked about was leveraged returns. And so this is the opportunity to use a bank or other people's money to buy a bigger property than you can invest in with just your own cash. So, for example, if you have $50,000 to invest, you have the opportunity to buy something that costs $50,000. Well, a bank will allow you to put that as a down payment as a percentage of the total value of the property. And you can use a bank to go out and get a much bigger property and produce larger cash flows, and that's called levered returns. So you're using other people's money to generate a return for you, and that's something that's pretty unique to the real estate market. The third thing we talked about was the tax advantages of real estate, and this is something that I think we've seen with our current president. Donald Trump has made a career in real estate investing, and certainly taken advantage of some of the tax benefits that go along with it. The 2 that I'm going to highlight here, and there are numerous, but the first one is depreciation. And what it allows you to do, the IRS essentially says, look, we know each year everything in your property is going to be worth less next year than it is this year, right? So your roof is a year older, so it's worth less. Your electricity, your plumbing, your HVAC, those things are now worth less. And the IRS allows you to depreciate them on a schedule. And depending on the type of real estate you're buying, the schedule of time that you can depreciate across changes. But what it allows you to do is essentially write off income that your property produces and shield it from taxes by depreciation. So at the end of the year, your property may make $100, but with depreciation, you may show a loss of $200. So to the IRS, even though you've put $100 in your pocket, you may have a net gain on your K-1 statement or your tax return of negative $100, right? You started with 100, I subtracted 2, and now I have negative $100. And so literally I'm making tax-free income. Now that comes back to you when you sell the property. It's called recouping the depreciation, but there's a strategy to defer that as well, and that's called a 1031 exchange. And what a lot of investors do, especially the really wealthy who don't need the cash, the 1031 exchange allows investors to roll from property to property. And there's a lot of rules around this, and I'd ask you to consult, a tax attorney, an accountant who can help you through this process, but allows you to sell a property, take the gains from that property, and rather than paying tax on those gains, roll it into another property. And that's called a like-kind exchange. And what that does is it defers the taxes, so you don't pay tax on the gains, and essentially you get a step up in depreciation. So your depreciation clock starts over and you can begin to depreciate that property. So there's a lot of really wealthy people who do a strategy called defer, 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 and die. So they literally exchange project by project, property by property until they pass away, and then that entire gain goes to their estate. And in the estate side of things, they get a step up in basis and the depreciation clock starts over. So it's a really unique opportunity that the IRS allows us to take advantage of in real estate. And again, I know I'm making light of it here, but it's a super complex issue, and you want to engage your tax professionals, legal professionals to make sure that you're doing that right. And then the fourth and final thing that we're going to talk about is a non-correlated asset. So real estate is not directly connected to the stock market. So if you have a big component of your portfolio attached to the ups and downs of the stock market, investing in real estate allows you to separate a piece of that. And even if the stock market's going up and down, that doesn't necessarily measure, or real estate doesn't necessarily follow the ups and downs of the stock market. Not to say there aren't ups and downs in real estate, there certainly are, but they may not follow, if real estate is really going up and the stock market's going down, you're kind of hedging your portfolio. So it really gives us an opportunity to take something out to a non-correlated version of an investment. So everything isn't reliant on the performance of the stock market. So again, the 4 reasons we think real estate's a great investment: overall returns, the opportunity to use leverage, the tax benefits, and then the opportunity to be invested in a non-correlated return. If you want to learn more about Reliant or our investment opportunities, you can click on the link below, www.reliantinvestments.com. Thanks very much. Hope you have a great day.